Michael, what do you think? Would a rate cut really be a tonic to the global economy if it were a coordinated one, as former Governor Warsh suggests?
It wouldn't be a tonic to the economy, Tyler, but it might be a tonic for the markets. So I do think it's kind of an interesting distinction there in that if you think about even Japan has flirted with negative rates since the 90s. Europe's had a negative rate since 2014, and it certainly hasn't done much for either of those economies. So I don't think it'll help the economic situation, but it certainly might help market confidence by putting a floor in those under the assets from that standpoint.
Loreen, what is your position on that?
Yes, when we look at central banks all over the globe, they've been continuing to lower rates. And we know in some areas we have negative rates. When you look at what just happened this week in Hong Kong, the Hong Kong government implemented fiscal stimulus, giving $1,200 or the equivalent of $1,200 to 7 million residents there. So I think what we're seeing is that central banks have done as much as they can, and at some point there needs to be fiscal stimulus as well to be another driver into the economy.
Michael, what are you hearing from customers and clients about their level of anxiety, about their anxiousness to do something, do anything? I think of the late, great Jack Bogle, who used to say, don't just do something, sit there in moments like this.
Yeah, I think that's a good point. I do think that the number of questions is rising. Certainly the anxiety levels are rising, but so far clients have stuck with a kind of a disciplined long-term plan, and they haven't overreacted. Remember, when we started this year, S&P 500 futures positioning was strong, equity market flows were strong, put-call ratio was very low, signaling a very bullish market, and there was a lot of very bullish sentiment, mostly from hedge funds and other alternative buyers. And I think what's happening there is some of those levered players that were overly bullish are getting moved from those positions, and that's exacerbating this volatility, this market action. It's not mom and pop, and it's not your traditional long-term institutional investor.
Loreen, with the Dow down about 700 points right now, and we were just debating the merits of a rate cut, a lot of people are saying, look, what good would a rate cut or more liquidity or looser financial conditions really do to solve a problem that is, a supply chain problem and, ultimately one of people trying to take care of their health?
Right. And I mean, when we look at it, there's a supply chain impact and there's the demand impact, right? So if you look at China, for example, we were expecting the Chinese consumer to buy about 28 million automobiles this year. I doubt very seriously that's going to happen to that extent. And if you look at the Chinese consumer now representing 60% of their GDP, that's significant. So if we look around the globe, there's definitely a slowdown in some areas going into recession. Thankfully, the United States, we are still the bright star amongst the global economy. So we're still hanging in there with a consumer that, as the Fed mentioned, is moderately strong as far as their growth in spending.
Michael, two questions. First one, what are Chinese stocks telling you? And second, is this the death of the bull market?
Well, I think what's interesting is that China, ironically, may be providing us the roadmap in terms of the way out of here. So they've enacted, and like Loreen was suggesting, they've enacted a tremendous amount of fiscal policy, monetary policy. We could debate whether they did a great job, but social distancing has helped, and the mortality rate has stayed fairly level. So not surprisingly, Chinese stocks have rebounded. Now, skeptics will suggest, of course, the Chinese government is buying securities there, propping up the market. But they've taken a number of actions to help support the economy, fiscal, monetary policy, as well as to address the virus. And Chinese stocks have actually started to outperform the rest of the market in recent days. Now, for me, to your second question, if you have courage, conviction, and capital, it's tough to call a bottom, but it may be time to start putting some money to work, sniffing around in bargains in places like technology and healthcare. We did see when markets hit their 200-day moving average, we did see some temporary buying come in. So I do think that this is not the exogenous factor to end the bull market and the expansion, but it could be ugly for the next few weeks.
All right.